Hey, Glenn, we've got you
Hello?
live here in the room.
Yeah, Morgan?
Glenn? Hey, we've got you live. You can go ahead and take it away.
Just proceed via the phone line. Well, great. I'm glad we worked that little technical roadblock out, and we're ready to go. Welcome, everyone, and glad to be talking to you once again. Welcome again, and I appreciate the folks, Morgan, Chuck at DTI, for allowing me an opportunity to speak. Let's just see how I can get rid of this on my screen. Close. Microphone, let's see. Bear with me, I've got a little block. Finally on close. Well, if you hold on, folks, I've just got something that's obscuring my view of my screen. Message, camera, and microphone access. Deny. Let's trying to get rid of it so I can see what we're talking about here. Hold on. This is a little... All right, I'm going to proceed anyway because I know the presentation. Again, folks, welcome. As you see on your screen, I've been working as a mentor / trader with the folks at Pacific Trading Academy now for approaching 10 years. If you require further clarification on some of the topics that I present today beyond what a 30-minute time slot or envelope will allow, you can reach me at least indirectly via the toll-free number 1-800-339-8588 at Pacific Trading Academy, as well as at our website, www.pacifictradingacademy.com. And I do one-on-one mentoring with traders where we go into detail that may be harder to achieve just in a 30-minute presentation. But hopefully we'll talk about some generic ideas that will complement your current strategies and models that you're using in your trading. As you see, the title for today's presentation, Trend, the Cornerstone of Analysis. And it is. I usually have my checklist of tools, and Trend is always at the top in terms of the ideas or models and relationships that I look to locate value in markets. So that's the reason for the presentation. Moving right along. Morgan, if I don't know how to progress the slideshow. If you can do it on your end, because I don't. If there's a way you can move to the next slide, or let me know or inform me of such, how I can do that. I'm progressing the arrow, but it's not going. Let's see. Let's see. If anyone can adjust, can you hear me, guys? Maybe it's someone in who's here listening, one of the invitees. All right. Let's see. Trying to move to the next slide so we can progress. Let's see. I'm pushing the arrow by clicking on it. It's not moving. Okay, thank you. Yeah, you guys, you'll have to remotely do that for me because somehow I'm not able to progress the slides. And I've got something blocking my screen, a little enable my microphone pop-up that will not go away. So fortunately, I'll just have to progress. I kind of know what I've set up and created for you. This is just a list of some of the topics I want to cover. Trendline analysis, this is probably, if not the oldest form of analysis, the second oldest form of analysis, been around approximately 200 years, is what I'm going to start with, some basic descriptions of what constitutes trend and thereby what enables us to differentiate one trend from another, which is essential. We all talk in terms of trade with the trend. It has become a market maxim, if not a cliche, but it has basis in fact. But it's meaningless if one doesn't know how to distinguish one type of trend from another. What criteria objectively are we universally agreeing on that should constitute or define a given trend so that we know, whether or not if you choose to trade with the trend or even if you choose not to, at least it's one thing to know you're trading against a trend. It's an altogether separate scenario to be unaware that you're, or oblivious to the idea that you might be trading counter to a primary trend. So we need to define it, and trend lines are a standard historical technical analysis tool, as I said, probably the second oldest that has been around to do so. The next, item B, indicator trend confirmation, is a relationship that draws on a 14-period RSI based on research years ago done by Dr. George Lane. That's the developer of the stochastic. And based on his research, I came up with some relationships that enable me to differentiate or distinguish one market type from another, i.e., a bull market versus a bear market. And this is kind of a proprietary idea that I came up with. It's not the only idea. It's just one way by which I distinguish a bull or a rising versus a bear or a falling market. Let's see. I am still, guys, trying to get rid of this block I have on my screen, but won't seem to go away. Hopefully you can hear me, but if not, and then underneath that I have a final category, the essence of trend, and that's the core premise that I want to present today. It is at the heart of all of my trading as an outgrowth of this concept that's labeled essence of trend. It constitutes the primary form of trend analysis that I utilize and apply consistently to locate good trades. Everything else is secondary in my repertoire or arsenal to in my quest for looking for good opportunities in markets. And it universally applies across time windows. So it scales. It's a concept that scales. Whether you're a day trader, whether you're a short-term position trader, or a longer-term investor, every and all time window in between and time horizon, this idea will have application too. All right, guys, if you could be so kind as to move to the next slide so we can move quickly along here. Thank you. This is just this is a currency forex pair, a weekly chart, dollar Swiss. The process of trendline construction. Again, this is the seminal, one of the oldest forms of delineating one trend from another. The idea is, in a falling market, you want to connect two reaction tops. It takes obviously 2 points to construct a line. If you see, in an obvious sense, in an intuitive sense, you observe visually motion of the market where the price is being offered lower. And during that period of time, 80% of the time or more, you won't see a market go from point A to point B in a straight line. It typically forms or moves according to a zigzag type structure, back and forth, back and forth. In the midst of a falling market, the consequence of this is you'll have reaction tops. The pattern that's peculiar or an attribute of a falling market that a trendline construction exploits is this tendency to form periodic pullbacks or retracements, creating a succession of lower and lower tops as the market evolves forward through time. Or as you're observing this, looking at a price chart, a two-dimensional surface, essentially you're looking at a pattern of lower and lower tops as you cast your gaze of the screen or on the chart picture from left to right. Two tops creates what we call kind of a tentative trend line, and then you extend that line outward to the same direction, outward and to the right, in a kind of in a southeasterly direction. And to the extent you have a third contact that validates that trend line. At a core, a practical benefit or utility of a simple trend line drawn in this manner, and here we have it on a weekly chart of a currency pair, forex currency pair. A simple application, practical benefit is that you can, in line with this concept of trading with the trend, number one, but waiting, say, in a downtrend, as evidenced on this slide, to sell a pullback. You can, the extended or extrapolated line sets up a zone of overhead resistance from which, if you wait for the market to test it, it represents a zone of resistance that locates an area from which would be a high probability zone to sell in the midst of a downtrend. So that's a primary practical application of a standard trend line as drawn as you see. Again, two points it creates the tentative line. A third testing where the market forms a third top and comes up and respects that line, validates that line. Then you simply project that line outward to the future in a similar direction with an expectation that the market as a function or a manifestation of serial correlation and a tendency of inertia to continue trending in that direction will respect that line. A violation of that line would be one indication of a possible or a more probable transitioning from one type of trend to an alternate type of trend. So this is just a very simple indication of an illustration of the basic application of a trend line process. This probably, again, one of the most basic fundamental initial constructions of technical analysis. If we can move to the next slide quickly, guys. I've got a lot of presentations. Okay, here's a variation on a theme. This is a technique that years ago Michael Jenkins, one of my teachers, taught me. I mentioned a moment in the previous slide that markets 80% or more of the time don't move in a straight path, a straight line from one point to another. Alternatively, they move in by a circuitous path. You're zigzagging 80% of the time. 10 steps up, 3 steps down, 16 steps higher, 11 steps back, so forth and so on. And so often we find an acceleration of trend lines, or trends rather. So if we were to simply work on a paradigm of linear motion constantly, forever, it's inappropriate to apply it to market motion. At various points, market behavior and the motion will deviate from a simple linear trajectory and become, in an extreme, it will become parabolic. As an interim, it might move in a logarithmic fashion. So again, I can't see the actual dates here, and that I don't recall, but this is a historical chart. This is an old cash chart of the S&P 500, a daily chart. It's quite disturbing to see this on my screen. I cannot get rid of this, guys. Hold on. I'm just going to try, because this is a unique technique of projecting and forecasting based on a variation of a logarithmic function. In other words, one of the tools I employ to extend past a simplistic concept of just a very straightforward trend line is I'll locate you in the starting point on the left. You've got a bottom, and that bottom date was July 16 in '96. It has a price low of 605 and change, 605.80. And then that's point, I think, A, or the one at the leftmost. And then, again, that was dated July 16 of '96. What I do is I convert that numerical price value to a natural log. The application of logarithms, whether common logs or natural logs in particular, tends to normalize variability of price. So especially when you're working with very large numbers, to convert them to a corresponding logarithm will normalize very wide or large variability of price fluctuation. And so this is one of the reasons I do it. So I converted that the starting bottom on the left side of the screen to a log. It works out to 6.4. Going to the right, the next higher bottom came in on April of '97. I'm going to go through this quickly, the details of which, again, for those traders who work with me, we can go a little more comprehensively. I just want you to get the thrust of the concept here. April of '97, the market formed a higher bottom. This is, again, in a falling market, you have a successive pattern of lower and lower tops. The reverse idea applies. The same idea, just in reverse, applies in a rising trend. You have a successive pattern of higher and higher bottoms. This is a characteristic feature of a rising trend. Well, this proceeds on ad infinitum until the trend accelerates, until there's an acceleration of trend. Okay, so we had the price bottom that came in, the second higher bottom to the right, moving to the right, on April 11 of '97 at 733. I convert that to a natural log, and that works out to 6.59. If I take the difference between the logs, I get a differential in log. I'm just changing or converting the interconvertibility of price to logarithm. So I'm just stating the prices in logarithmic terms. The time difference between the first bottom on the left, July 16 of '96, and April 11 of '97, is 269 days. So I can get a velocity the average velocity or change in logs or distance that the market has traveled in logarithmic or average logarithmic points per day. And so I just take the difference in logs, which works out to 0.1912, and I divide it by the time period elapsed, 269 days, and I get my change in price stated in logs divided by the amount of elapsed time, 269 days, and it works out to 0.0007108 average log points per day. All right, I can use that to project a price target out into the future, and that takes into account the possibility of an acceleration. In other words, an excursion away from a pure, simple linear trend and one that might be accelerating as we see occur. And this is evidenced by the second trend line that I've drawn that's moving up at a steeper clip or a steeper angle. All right, I take my answer, my average log points per day, that's a velocity, change in price stated in log terms, and I simply which is 0.0007108, I add that to my last price stated in logs, and I get a price. In other words, the last log that I got, the date of 4/11/97, if you can see that point where the price low is 733, I just take my average velocity of logs, and I multiply that times the number of days from the medium point B, that came in April of 97, to the next point, which is October of 98. All right, so that's 545 days, and I take my velocity of trend, and I multiply the number of days times that, and I get a number. The number I get is 6.9852. Essentially, if you have a scientific calculator, just take the anti-log of that, and you get a corresponding price target of 1080. Again, I can't see, my screen is blocked, but that's the thrust of this idea, and it's a very it's more of a sophisticated idea, so as an extension or deviation away from a pure simplistic trend line and formulation or model, taking into account that markets are not constantly linear. We see linear motion at some points in time. At other points in time, you see a deviation. Let's see. Just trying to get rid of this on my screen. I cannot enable my microphone. I don't know. Anyway, this is just a more sophisticated application that takes into a model of trend line analysis, taking into account that often markets will move from a linear type of motion to a logarithmic type of motion, and then following on that line of trajectory all the way to parabolic. All right, if we can move to the next slide, guys. If you can progress to the next slide. All right, this is an altogether means, this is what I alluded to, this is a trend confirmation via a 14-period RSI. This is a very discrete and objective technique. It works specifically with the 14-period RSI, and there are two levels that I came up with. George Lane, that's the developer of the stochastic oscillator, many years ago asked an insightful question. He said, wouldn't it be logical to assume that if we were doing overbought, oversold analysis with a RSI where the standard generic thresholds are 70 and 30, that's what you'll find at least 80% of the time in any textbook on an RSI oscillator. But that's across the board. In other words, when the RSI crosses above 70, it indicates the market's overbought. When it drops below 30, it indicates oversold. Lane's reasoning was that's across the board. It would make we could make that more specific if we delineated, at least in a global or macro sense, between two types of major market motion: up motion or bull market activity versus down or bear market activity. So that's what he did. He came up with two sets of numbers. I won't go into the details of that analysis, but basically, I took two of the numbers that his research came up with in order to address a major question. At any given point in time, consciously, as traders, all of us, either consciously or unconsciously, we're always perennially asked with facing a question. When a market has been trending up, let's say, and at some point stops its rise and starts counter motion, starts to come down. The point where it stopped going up and started to come down creates a top, and vice versa. When a market has been coming down or offered lower, and then at some point it stops and starts to go up, it forms a bottom. The question always that we're constantly on any level of time, whether you're an intraday trader trading off a tick chart from one extreme all the way to the opposite extreme and a long-term investor, when those tops and bottoms form, the question is how to interpret the counter motion, the subsequent price action. In other words, if a market's been rising and all of a sudden it ceases to rise and starts to come down, should you be thinking of the following price action as a seminal new generic sea change, a start of a new bear market? Should you be looking to exploit the short side of that market? Or is it just a temporary pullback in an otherwise generic bull? Which one is it? And furthermore, do we have an objective means by which we can differentiate one class? How do we define our price action? Is it a pullback or a retracement within a bull, or is it a new beginning for a bear market? How can one differentiate objectively so as to make an informed trading decision, or at least an assessment of the state of the market? There have been all sorts of ways by which this question has been addressed. One way that I have is this, that I came up with about 8 years ago. Watch a corresponding response of a 14-period RSI. In other words, market's been rising, let's say, as we see from the left side of this chart, into the first vertical purple or lavender line. Once it's been rising and it hits a top and it starts coming down, any and all falling price action insufficient to cause the 14-period RSI to drop below 40, I'll interpret as just a pullback, but still an otherwise generic bull market. If and when a market continues its descent to a point far enough down, low enough to cause the RSI to drop below 40, it's an indication more probably the market has transitioned from a bull to a bear. All right? The opposite is true. Let's say a market's been falling and it stops dropping, forms a bottom, starts going up. The question will arise in your mind. How to interpret that rising price action? Is it merely a rally within a broader generic bear market, an opportunity to add to existing shorts or initiate a new short? Or alternatively, is this a start of a new bull market? Should I be contemplating establishing longs? Which one is it? Here's one objective means of defining that and assessing the market state. If and when a market which has been falling stops falling, forms a bottom, starts to come up, any rising price action insufficient to cause your 14-period RSI to eclipse the level 65. That's an important threshold. I will interpret to be a rally within a bear market, still an opportunity to go short. However, if the market in that continuum continues to rise above high enough to a point where it causes your RSI oscillator to exceed 65, that's a stronger indication, based on my analysis, of a more probable transitioning from a bear to a bull. It's one form of analysis or one relationship that I key to differentiate a bull or market. I now have one objective. It's not the sole means, again, of differentiating at any time for any market on any segment on any time frame, at least making a macro distinction between a bull or a rising and a bear or a falling market. So that's an indication I look to. All right, if we can move along to the next slide, guys. If you could just progress to the next slide. Okay, another completely separate, it's always good in principle to have very, very, very different models or concepts or relationships to extract or procure the same type of information. No one model or relationship has a perfect sensitivity to market motion. Therefore, I don't want to trust it. I don't want to depend on it. When you have very different indicators, models, relationships, where in spite of their inherent constructional differences and thereby their different sensitivities to how different markets move at different phases, when in spite of those inherent intrinsic differences, they tend to generate similar responses or outputs. In other words, there's an alignment of response. That's a clearer, deeper indication you're on the right track. The information, you can have a higher degree of confidence in the agreed upon output of the multitude, however many. It doesn't have to be a lot of differing models or relationships you're looking to. Ichimoku, those of you who are familiar, you know it was developed many years ago to be a trend following methodology. It's a discrete trading system. I don't treat it as such or use it as such, but I do look at it just in a generic sense to differentiate a trend, one trend from an uptrend. A basic tenet of Ichimoku analysis is that when the price is above the thick band or swatch, that's a cloud, that's what's referred to as a cloud, we define that in a general sense to be an uptrend. When the market breaks to below the cloud, it's indicative of a falling market. It's that simple. There are I've done many webinars solely just on this one system, but I don't want to, again, That's not the point of this. I just want to talk. It's one means of distinguishing a trend, which in turn is very different from, say, the previous method by looking at a correlation with price action and a corresponding response to an RSI. Very, very different approaches, and that's the point I want to highlight. You want to form a more probable, higher probability a viewpoint as a consequence of combining a few very different concepts or models. When they line up, that gives us in aggregate that creates a stronger argument for a particular view. Let's move to the next slide. This is just an example of a transitioning where the price broke below the cloud, indicating a transition from a bull to a bear. Can you move to the next slide? If we can just progress to the next slide, guys. Thank you. This is just another example of Ichimoku. Again, for some reason, the majority of my screen is obscured. I cannot believe we're having this technical snafu, but I know the slides too well. This is just an Apple daily chart of Apple, and again, it shows a possible price break of below the cloud. The green and the red area. The color of the cloud, generically green, it indicates the strength of the zone of support if the price is above it. If the price is below, its resistance. Green indicates strength or strong. Red indicates weaker zone of support or resistance, depending on where the market is relative to the cloud portion of the parameter set. Let's move to the next slide. I don't want to spend much time on that. I want to get to the essence of the trend very quickly. If you can progress, guys, to the next slide, appreciate it. Okay, here's an indication in a real world. This is natural gas. Notice how long the market was moving down. I'm emphasizing that for a reason that will take on relevance at the end of the presentation today. Notice we hit this bottom. Notice the bottom over on the right side of the screen, and then afterwards the market has been rallying for about the final 16th of what's shown on this chart. But the majority of the price action depicted on this chart, that's clearly the trend is down. But all of a sudden we hit this bottom over here, and then we've been moving up into the end of the chart on the right. The question again is how should one interpret that bottom? Is it a sea change point of transition, marking the end of a bear market and the start of a new bull, and as such we should contemplate strategies to exploit long or appreciation, or is it just a temporary pullback or retracement in the midst of a broader generic bear market? Which one is it? Again, here you have a 14-period RSI indicating that the RSI value, or the market rather, after or subsequent to the bottom has risen to a level high enough, whatever that level might be, sufficient to cause the RSI to exceed 65. Again, the two threshold levels that I worked out years ago, 40 and 65. If a market, after having dropped for a period of time, however far it's gone, ceases its decline and starts to rise, and the question is what to make of that rising counter motion relative to the prior pullback or falling price action or downtrend. Where's the point of confirmation that we switch or the market transitions from one generic type to an alternate type? Again, in that case, if once the market, after having dropped, rises far enough to cause the RSI below to cross above 65, it's much stronger indication statistically that the market you can interpret as transition from a bear to a bull. And then the opposite would be the case. If we had primarily a rising trend and all of a sudden market hit a top, and then starts coming down, at what point should you interpret the falling price action to be a new bear as opposed to simply a pullback in a bull? Once the market drops far enough to cause the oscillator to drop below 40. So those are the two critical threshold levels pertinent to the scale of the vertical axis of our RSI oscillator, 40 and 65. That's just an example of that technique in motion. Move to the next slide, guys, if you would. If we can slide to the next. Okay, this is the core essence of what I want to talk about. What is trend? This is something that Jimmy Sloman and Wiles taught me many years ago. What is trend? Something is repeating. Serial correlation. What is the most basic form of repetition? Exact repetition. What does this lead to? Perfect symmetry. So you can see points A, B, and C moving from left to right indicate or mark or designate the past, what I call the present or the now moment, and the future. And the most probable, if for any given phenomena that occurs in the past, given a model or a algorithm of expected linearity, the most probable expected ending point or destination point for any phenomena that occurs at any given point in the past, at any given point in space, in time-space continuum, will always be in the future point. And this is something referred to as the second reflection. And it's a manipulation through the axes in a three-dimensional system. And this is a concept, again, ultimately, as we'll see in a minute, that is no less a genius than what Isaac Newton came up with or unearthed in terms of an aspect of how moving systems, both linear and nonlinear, function in our realm of existence. Okay, so this is just the theoretical outline of what's at work here. I'm simply exploiting it for profitability and market action and market analysis. Let's move to the next slide, guys, so we can see an example of what this is all about. Velocity of trend. Where this concept works best is where you have the higher the velocity of trend, the more probable that perfect symmetry, the exact repetition, will play out. So that gives me a discrete, objective means of differentiating as a candidate for entry one market versus another. The best, simply the critical component is velocity. The higher the velocity of trend, the more probable that trend will continue. Very simple. That's the most important thing I know. I know a lot of things more complicated than that. I don't know anything more relevant to extracting financial dollar and cent profit from a market's move. Velocity of trend. So how can I differentiate the velocity of one market versus another? Well, if you're looking at a price chart, which is essentially a flat surface, it's a two-dimensional plane. Slope. Slope is the two-dimensional analog of velocity. The steeper the slope, the higher the velocity. So if I'm looking at a set of 30 charts of 30 different markets, and I want to find for my money the best market to select as a possible entry on any time frame, no matter market, A to Z, I want to look at slope. The steeper the slope, the higher the velocity, the more likely that trend will persist. What's the steepest slope of all possible? A vertical line. It is the standard reference on a continuum of possible velocities. I rarely see a market going straight up or straight down, but that represents my standard. Let's move to, this is just an example of an obvious, this is a chart of silver historically. Same thing, the previous slide was an uptrend, this is a downtrend, same thing. I am looking, the first indication that catches my attention in terms of my quest for good opportunities, high value areas in a market, for setting up a possible strategy for an entry, is velocity of trend. This supersedes any and everything else I know. At the top of my checklist for the tools that I utilize to select opportunities. I know, again, my second most important item is time. Implicit in that are things like the analysis and work of Gann. And then Elliott, it would be third on that totem pole of importance. As important as those things are, they constitute a second and a third. They are way less important than what I'm referring to now. Ironically, there's an inherent simplicity of this because it took an insight of one Isaac Newton years ago to unlock what was beyond complicated, was unknown. Okay, so here's just another example of the U.S. dollar index on the opposite. The fact that, from this top here in the middle of the screen to the end, it's going down, and going down at a reasonably deep enough slope is sufficient to garner my interest. Okay, to further increase, so again, I'm looking for serial correlation. I'm looking for repetition because exact repetition creates perfect symmetry, and that correlates with perpetuation or continuation of a given trend, and that's how you make money, unbeknownst to us or consciously. It doesn't matter. To further increase my odds for success with this ultra-simplistic method, two market principles I employ. If it's a market that's going up and I'm impressed that it's moving up steeply enough, that is with a high enough velocity, or steep enough angle, or great enough or high enough velocity, I'm looking to buy. My corresponding concept or principle is buy above resistance. In the opposite case, where a market such as this dollar index is falling, and I'm convinced it's falling at a rate or a clip good enough to be a good case for a trade, sell below support. Buy above resistance, sell below support. I realize this is a paradigm or a philosophy opposite the way most 90% of traders trade. If we can move to the next slide, guys. I know I'm short on time. I want to get really quickly to the end here. If you can just progress the show. Okay, again, just another case. This is a weekly chart, currency forex pair, euro-yen. Same thing. This is what I'm looking for. I'm looking for markets that are already in motion. Contrary to what I used to think in the first 10 years of my career. I've been doing this for 30 years. And now what I'm looking for, it doesn't matter how long or how far a market's moved. In fact, most traders interpret that given data, the fact that a market's moved persistently in a given direction and has carried a great distance, the differential in price has been great, as an indication that a transition point is more likely to occur. I look at the same data set and interpret and come to the exact opposite conclusion. I interpret it as the market's way of telling me what it wants to do. The reason this, you can move to the next slide, guys. The reason this ultra-simplistic form of analysis works as well as it does is because there is nothing easier for a market to do other than to continue doing what it's doing based on a function of the amount of work and thereby the amount of energy required. Something has to happen for a top or a bottom to form in the world, a point of transition. If you look in any textbook, any seminar, any analysis treatise on markets, 80% of the content will have to do with informing you and me, the observer and / trader and ultimate participant in the market, in terms of anticipating in advance and projecting where a market's going to stop doing one thing and start to do something else. That manifests as what we call a top or a bottom, a transition point. I look at that as an extraordinary event because something external to the market had to happen to facilitate and enable the market to stop doing one thing. Work had to happen. Energy had to come in. Barring that contingency of energy coming into a market, any market on any time frame, everything from A to Z. As I was in a meeting one time, someone said anything from a jelly bean to a soybean. It doesn't matter if you're an equities trader, a derivatives trader, options, etc. It doesn't matter what time frame. All markets respect first and foremost this highest principle. Yeah, the technical relationships, the economic relationships, be they fundamental, be they technical relationships, be they quantitative, they all work to some extent, and the reason they do when they do is because they adhere to a higher principle, the first law of motion. That's all I'm talking about. All right? Slide, if you could move to the next slide, guys. Can we move to the next slide? Okay, same thing, just short-term persistence. Move on. I want to just quickly, I think I'm running out of time, so if we could just move very quickly to the final slide so I can tell you I have a trade for the week, which is to short the S&P, but again, case for reversal. Yeah, the backup, daily, okay, this is the S&P. These are my projections. I guess we're out of time. I am basically expecting a major move in the stock market. I trade the E-mini S&P. I'm working orders just below the current price in the June S&P to go short, and I expect a move to occur by next Wednesday. This is a forecast. I always do this in my webinars, as you see, based on a confluence of time and price, and so hopefully you've gotten something out of this today, and as you see, we are offering webinar specials, 50% discount. You can reach me again at 1-800-339-8588. Again, sorry for the technical issues because I can't see my screen, but hopefully you're hearing me and have been able to piece together at least the thrust of what I wanted to convey. And should you have interest in learning more or obtaining additional clarification on any of these topics or anything related, you know how to reach me given the information on your screen through Pacific Trading Academy. And once again, I'd like to thank Morgan and Chuck and all the folks at DTI. You have a great organization, and I'm happy to be a presenter once again and wishing you all the best trading. And again, you know how to reach me if you have additional questions, and wishing you all the best and good trading going forward.
Much. We appreciate you being a part of today's event. And at this time, I'm going to turn things over to our next speaker. John, if you can, come on to a quick audio test, and then I will turn things over to you.